Go actionable insights.
There's a good morning and welcome to the Indalama Insights radio show. Today, we're diving into a topic critical for wealth creation, and that is building your investment portfolio. Tips for success. Joining us is CEO of Insight Partners Africa, Ms. Mkonke Mkonkela. It is good morning and welcome, Mkonke.
Good morning, Leslie. How have you been?
Great, great. And how are you?
I'm fine, thanks.
Great. To kick things off, Mkonke, what
hmm
exactly, though, is an investment portfolio, and why is it a crucial element in wealth building?
Thank you, Leslie. So, today we are trying to help our listeners and viewers to understand what an investment portfolio is. Because when it comes to investments, we often hear about an investment portfolio, and this is simply a collection of assets in terms of investments that you've made. You could have invested in the stock market, so you have an asset called shares. You could have invested in the government bonds or even corporate bonds. So you have an asset called bonds investments. You could have invested in real estate or property, and that is an asset that we call property. You could also have bought maybe commodities, gold, and others, even cryptocurrencies. So a portfolio is simply a mixture of these investments. And it's important for you to build an effective investment portfolio because a portfolio that is effective is one that is diversified, considering, especially looking at the example I've just given you. So if you've got investments in different assets, we call that a diversified investment portfolio, which is what we should all be aiming to create. We should not just focus on one investment asset like government bonds. There are a lot of other investment assets that we need to start thinking about in order for us to create a strong and effective investment portfolio that does what we want it to do. So basically, that is what an investment portfolio is.
Mhm.
Mm.
Now, setting clear goals is crucial. Kongi, how can our listeners define their investment goals and why is this step critical?
Thank you, Leslie. So, absolutely correct. Setting clear financial goals is very important when you're creating an effective investment portfolio. This is because when you start with investment goals, and examples of investment goals could include building a house, maybe funding your child's education, probably saving for retirement. So these are examples of financial goals that you might have. So when you have clear financial goals, it is easy for you to know how much you need to save and later on invest and what kind of return you want to make and when you want it back in order for you to actualize your financial goal. So when you are saving with a goal in mind, it's even easier for you to know what kind of investment assets you should be investing in because your financial goals will be aligned with your assets, your investment vehicles or assets. So that is why it's very, very important for you to define your investment goals and also know, what investment assets to align your financial goals with. So that is what it is.
Mhm.
Yes.
Now, risk is inherent in investments.
Mhm.
How can one assess their risk tolerance and why is proper asset allocation so crucial?
So when we talk about risk, every investment carries a risk. There's a misconception that some investments are not risky and are easy, but every investment carries a risk, and so we need to be able to understand what our risk tolerance is. And for you to determine what your risk tolerance is, there are quite a number of factors. And one factor is the time horizon that you have for you to invest. All of us are different, and we are starting this investment journey at different ages. So we don't have a lifetime to make these investments. So this is where we consider how old you are. If you are younger, you probably have a longer time horizon compared to those of us that are older, and therefore this determines your risk appetite and also determines what kind of investments you should be making. So that is one way you can determine your risk appetite. The other way you can determine your risk tolerance is how much income you have available for investments, and also if you've got debt, if you've got family responsibilities, you've got maybe quite a number of kids that you need to finance, dependents, all that uh, matters when it comes to determining your risk tolerance. Let's say you've got quite a lot of responsibilities in your family and maybe you've got debt. It means that you need to be moderate or conservative when it comes to what kind of investments you undertake. So that is how you need to assess your risk tolerance. So it's very important that you assess your risk tolerance because it determines what kinds of assets you can invest in. Yes, Leslie.
Okay. Now,
Mm.
diversification, it's
Mhm.
often emphasized when we're talking about investments. But can you elaborate on effective diversification strategies and why it's crucial for portfolio success?
Thank you so much. So, diversifying your investment is simply about considering not just one investment asset, but considering different investment assets. I can also marry diversification to asset allocation. They are quite related. So asset allocation is where you consider or you diversify your investment in different asset classes. So for example, stocks, bonds, and real estate. So that is asset allocation. When it comes to diversification, you could diversify even in a single class, let's say stocks. So rather than you just investing in stocks, mining stocks. Nowadays, we are hearing a lot of news about mining companies coming on board, and I hope many of these are going to be listed on the Lusaka Securities Exchange so that we can all be shareholders in these mining companies. So I hope we can see that. So when you buy a stock, let's say in a mining company, if you want to diversify your investment, you need to also buy an investment maybe in an IT company or a manufacturing company. When you do that, you are diversifying your investment. You don't just own a mining stock, but you also own stocks in an IT company or a manufacturing company. So that way you are diversifying your investments. It's really important for you to diversify your investments and also ensure you've got correct asset allocation because you need to spread your risk. Remember, we're speaking about your risk tolerance. And when we talk about risk, it's not something you should be afraid of. It is something you need to manage. So when you understand your risk tolerance and what kind of risk you can take on, it is easy for you to then diversify your investment. You know what kind of investments to invest in. And that way, you're spreading your risk so that if one sector is not performing really well, let's say mining itself, maybe this is a new investor who's just pumped in money, you're a shareholder, you don't expect to get your dividends right away, but you're hoping for the long term when the mining company becomes profitable, then you can get your dividend. So in the shorter term you could have this share, but then there's an IT company that is doing really well and you're earning your dividends. So that way you spread your risk and your returns at the same time. So that is what diversification allows you or enables you to do.
All right. Well,
Mm-hmm.
today we are looking at building your investment portfolio, tips for success. And of course, with us on the show is Mukonke Mukompela. Remember, you can follow Mukonke on YouTube and follow the show from there as well. If you have any questions or contributions you want to make, you can make them from uh, that side as well. That is YouTube. Various investment options are available. Macaulay, can you guide our listeners, though, through popular investment vehicles and strategies, providing examples so people can understand?
Thank you, Leslie, for that. So you're absolutely right when you say we've got a lot of investment vehicles. So I don't want my listeners and my subscribers going away thinking that it's all about government bonds. There's quite a lot. And this year, I'm hoping we're going to explore others in as much depth as we've done with government bonds. The first one I want to consider this morning is stocks or shares. So you can invest on the stock market by buying shares in companies. And in Zambia, you can do this through the Lusaka Securities Exchange. And fortunately for us, next week I'll be looking at how we get started investing in the stock market. And you can invest even overseas. You don't need to restrict yourself to the local securities exchange. You can invest overseas as well, as long as you've got a broker that is based overseas. So you can also diversify your investment by buying shares. The other one that we've come to know really well is the government bonds. When you lend money to the government, you expect to earn interest income. And therefore, this is a very good investment, especially for those that are conservative or moderate risk. If you are really, your risk appetite is not that high, it's very low, you can consider investing in government bonds because that is assured returns. It's a fixed income. You know, after 6 months you will get your coupon income right into your bank account. So that's an investment you can start with if your risk is moderate or conservative. If your risk appetite is aggressive, or you've got a huge risk appetite, you are young, you've still got a long way to go in terms of the time horizon, you could consider investing in the stock market, because in the stock market we expect returns over the long term. Then the final one I would like to speak about is real estate. Real estate is where you buy a property or properties and hope to make income that is also fixed income, as well as an appreciation in the value of the asset. This is a very important investment, one that we're actually going to pay particular attention to this year as well. How can you start by just buying, a very not expensive asset, property somewhere, rent it out, maybe to students, or maybe to single household people, working class men and women, and gain your fixed income from that investment. So this is how you go about thinking about various investment options. Now, when you do a mix of these investments, this is how you create an effective investment portfolio. It's a mix of all of these that we are talking about. Yeah.
Okay. It's interesting. And now, what's another key though to generating solid investment returns over time?
Another key to generating investments over the long term, and this is very important, one of the consistent investing. You can start even with a small amount. So for me, I think this is a very important key to solid investments over the long term. Many people ask, can I start with 1,000 kwacha? My salary is not that big. Is it just for people that are wealthy? No. In fact, you can start with as small as 1,000 kwacha. What is important is the consistency. So if you can regularly save your money, build up a bulk amount over the long term, and then invest that amount maybe in the government bond, in a stock, or even in a property, if you are very, very disciplined, that is what will get you started. And also the time, and when you're actually able to save consistently and regularly and not withdraw the interest or coupon incomes and use it for personal usage, but rather reinvest it, you're going to utilize the power of compounding, because compounding works with time, and as well as ensuring that the returns are kept within investments and not utilized for consumption. So this is very important in terms of investing. So you need to utilize time, consistent saving and investment over a long period of time. That way you're going to see the power of compounding work for you.
Okay.
Yeah.
Just a question though.
Mm-hmm.
Where do unit trusts lie in this whole mix of investments?
Thank you, Leslie. So unit trust is it's a combination of shares. In fact, unit trust is what we call different people contributing their money to invest in a trust. So you own a share, a unit of that investment. So it's there's a word that I'm looking for. So it's like a shared investment scheme with other investors. And the unit trust depends on what the unit fund manager is strategy is. They could say we want to invest in government bonds. So they've established this unit fund specifically to invest in government bonds. Now, because you don't have enough money yourself as an individual to invest in government bonds, you contribute with other investors, and the fund manager will then be able to use that combined money to buy the investment in government bonds on your behalf, and then you share the return, all of you. The fund manager could decide to say, we want to invest partly in bonds, partly in shares, partly in real estate. So that is a combination of investments. So that could also be a unit trust. Okay, so it is simply a shared investment scheme where different people contribute their money into a trust that the fund manager then invests. So you need to understand what the strategy of the fund manager is. What kind of investments are you investing in? So ask those questions to the fund manager. You could find that their strategies focus just on shares, or their strategies focus just on bonds, or they've got a combination of shares and bonds, which is what you might be hoping for. Yes.
Okay, so that is like like a combination of everything.
Yes.
And you just, this is why you pay monthly for it most of the time, isn't it?
So it also depends on the fund manager. Others, you can pay a monthly contribution to the unit trust. Others, you need to pay a fixed amount, a one-off amount. So it depends on the fund manager and their investment scheme in terms of what strategy they've implemented.
Okay.
Yes.
All right, that was a thorough overview on how to create an effective investment portfolio with Mkonke. But any final thoughts you would like to leave our listeners with today?
So it's something that I always say. Investing sounds really difficult to do, but you need to take it a step at a time. You can't eat an elephant in one day, and understanding that you need to have an effective investment portfolio is really, really critical for you to ensure that you are, investing properly, and also ensure you've got financial goals. Don't invest haphazardly and without a plan. Have a financial goal. That way it will be clear in terms of what investment goals you target. Thank you so much. And good morning to everybody online, Mr. Katongo, Mr. Jory, and many others that joined us this morning online. Thank you so much.
Great. Mkonke, it is a pleasure having you on the show.
Thank you. Have a good day.
All right, do join us next week once again when we will be discussing how do I invest in the stock market. And I think this will be very interesting as well for you to listen to. Until then, may your portfolios thrive, as they say. I'm Leslie signing off until next Tuesday.